All right, welcome to Glidex Forex Academy. This webinar I'm going to be presenting an introduction to Forex trading. So we want to see what Forex trading is all about, the concept of Forex trading. And thank you for watching the video. And to our subscribers, thank you for subscribing. And I'm sure if you like the video, you would like and share with your friends and drop a comment if there's any question or any comment. All right, so let's get into it. So what is Forex? What is Forex? I'm sure you must have heard about Forex. To come and check this video, you must have heard about Forex from a friend or somewhere. Forex is the short form of foreign exchange. Just as you have a lot of short forms for a lot of things, a lot of terms, so Forex is the short form for foreign exchange, and it is one of the largest markets in the world with a total daily liquidity of $5.3 trillion. One of the largest. And we also have the New York Stock Exchange, which is also one of the largest market. Forex trading has an average daily turnover of $5.3 trillion. All right, every trading day. Now let's go into the concept. I want to explain in a very simple way the concept of Forex trading itself. I want to bring it into the simplest term possible, and in a way that you would understand. All right, now I want to give you a scenario. So imagine that you are opportune to an insider information about iPhone 13 or Apple products now, and so say someone told you that iPhone 13 would be released in 2 weeks. Now, what do you do with that information? To a layman, it's just an information, something to, spread around, put on your WhatsApp status, share on your social media pages and the likes. But then to someone that is financially oriented or economically driven, so if the person has a tendency of making money from opportunities around, that person would easily see that you can make money just with that information. How do you do it? Okay, you understand the principle of demand and supply. You know that once another product comes into play, a competitive product, then the price of the other product would drop. All right. So you get iPhone 13, of course, it's going to compete with iPhone 12 in the market. So definitely the price of iPhone 12 will come down because of the high demand for iPhone 13 instead of iPhone 12. So now you don't have iPhone 12, but you do have a friend that owns an iPhone 12. Then the next thing is to collect his iPhone 12, sell the iPhone 12. Just like, oh friend, I want to just to borrow me your iPhone 12, I want to sell your iPhone 12, whichever way, and I'm going to give you back in a couple of days. I'm going to give you a brand new iPhone 12. They're like, oh cool, I would like a brand new. Can you get me the silver color? Sorry, I don't know if there's a silver color. All right, so you get to the market, you sell the iPhone 12, and then iPhone 13 comes out, and then in few days the price of iPhone 12 drops. Then you go to the market again to buy that same iPhone 12 at a lesser price. All right, then you give your friend the iPhone 12, okay, and then you have extra profits because you have sold at a lesser price than you import at a lesser price than you initially sold it. So this is one of the concepts of Forex trading. You just bought and sold, you just traded, okay, based on price fluctuation. All right, so let's move on. Another analogy now, something closer to currency. Take for example, you you're traveling out of your country, can you go to the embassy and you have to exchange your currency, your local currency for that country's currency. Now after exchanging it, there's going to be a variation in price. Say your currency, that currency is a price 80 or 480 or whatever. Now when you got home, the taxi driver took you home to your friends, or one of your friends came to pick you, whichever way, and then your friend told you that, okay, I'm going to be footing all your bills, you don't have to pay anything. All right, so don't spend your money, just keep your money. And you're like, oh cool, thank you. Then after a couple of weeks, say 1 or 2 weeks, you came back to your country, and when you came back, you have to exchange that currency, that country's currency, to your own currency again. Now at the counter, you were told that there has been a variation in price, and as such you got more than you had actually exchanged in the first instance. Say you exchanged, okay, let me use Nigerian naira. Sorry, apologies to the overseas viewers. Say Nigerian naira, 10,000 naira now was what you exchanged for some dollars, and when you came back, you got about 11,000 naira. That is, you have a 1,000 naira increment. So you have a 1,000 naira profit. Now you did not do anything, so to say. You did not buy a pair of books, you did not buy something physical. It was just because of the fluctuation in prices of the currency. All right, your local currency and the foreign currency. Okay, because of the fluctuation of prices, that was how you could get an additional money. All right, so I hope this analogy is as clear as it could be. So let's move on to market participants. Who are those that makes up the market? Who are those that participate in the market? Okay, number one is the super banks. All right, we have big banks that actually participate in the market, and we call them liquidity providers. The whole bunch of them, they inject liquidity into the marketplace. They have the higher percentage, or the highest percentage. And I hope you're taking note, because I did not write a whole note on the slides and all that, so I hope you're taking note. So they provide the highest percentage of liquidity to the market. The super banks, now they are the largest. They are not much in numbers. Actually, you can count from 1 to 50 or 1 to 30 or 1. In contrast to retail traders, you cannot number the retailers in you quantify them in numbers. You can't do that, because there are so many, so much. All right, so the super banks are few, and they are they're part of those that drive the market majorly. Number two, the large commercial companies. We have companies like Apple, we have companies like Microsoft, we have companies like those large companies now, BMW, Ford, that actually trade the market, they trade the financial market. So they also inject liquidity into the marketplace, but not as much as the super banks. Now, number three, we have the government and the central banks. All right, so what role does the government plays in the market? All right, now the government do not directly influence the market. That is, they do not directly the government cabinet will not say, okay, let's put $3 trillion on a particular currency pair, or let's withdraw $5 billion on a particular currency pair. They don't do that directly, but they do so through policy. They actually influence the market through policies. Now, Donald Trump could just wake up one morning and said, all stocks begins to skyrocket. I had this particular trade That was last year on gold. And then I woke up to see a tweet by Donald Trump. He was talking about being quarantined, being in isolation from coronavirus. So he said he has been tested positive. And few minutes after that tweet, man, come and see gold dropping. Like, it was dropping. It dropped massively. I mean, wow, it happened live. Like, I was looking at it just few minutes after. It was not even New York section. We have different market section, which is, I'm going to talk about it at the end of this presentation. We are not even in a high volatility trading section. We are just, it was just it was not even London section yet. Those that understand the sections, they know what I'm talking about. It was just dropping. So government policies also affect the market and the way people are going to react to the market. Central banks as well. Then the last one, the retail traders, and I myself and you are part of this. We are part of that body, the retail traders. We are the majority that cannot move the market significantly. We cannot move the market significantly, even though we are the majority. All right. So the retail traders do not have enough money, enough liquidity to move the market. All right. So we are traders nevertheless. Forex terminologies. Now let's see Forex terminologies. The terminologies used in Forex trading. A whole lot of professions now have their own trading terminologies. They have their own trading terminologies. The doctor, has their own. Doctors has their own trading terminologies. Lawyers does, and a lot of other careers and professions. So also Forex trading, we have terminologies that we use in communicating. And if you are ignorant of it, you will not be able to flow along in that line of communication. So now let's talk about the market positions. Let's talk about market position. As what position can you assume in the market, for example? In simpler terms, now I want you to picture yourself in the marketplace, in a physical marketplace, and the lot of people buying and selling, transacting in the market. Or you are in a mall now. You can either be bringing, now in a mall you actually you're going to buy something from a mall, but now if it's a physical marketplace, you can either be buying something or be selling something. All right. So also in the foreign exchange markets, you can assume either of those positions. Either you are buying a particular currency pair or you are selling a particular currency pair. So if you are buying it, the word buy is a word. Secondly, the word long. You can say I am longing this pair. I'm longing this particular currency pair, or I'm going bullish. Or you say I'm going bullish on this particular currency pair. All right. Secondly, if you're selling, you say I am selling this particular, or I'm shorting it, or I'm going bearish. All right. Someone asks you, what are you doing on Euro USD? So I'm going bearish on Euro USD at the moment. So, the person understand that you are selling that particular currency pair. Now, number 3, we have the bears and the bulls. As you can see here, the bears and the bulls, they are the market forces. For every market, they can't just be a market that will be based on, just imagine a market where there are only sellers. Everybody just comes to the market to sell. No one is buying. That is not going to make much sense for a market. So for every market, there is a buying and a selling involved. Commerce now, right? There's a buying and a selling involved. So those that are buying in that market are called the bulls. They are pushing price upward. And those that are selling in the market, they are called the bears. They are pushing price downward. All right, in the financial market now, in the foreign exchange market. All right, let's move on. Structures. Okay, so let's talk about structures. We are still continuing Forex terminologies. Now there are two types of structures majorly in the market. We have the ranging market and the trending market. So the ranging market is such that the market is consolidating. You can also call it a consolidating market. The market is consolidating, going up or down. It's just moving sideways. It's moving sideways. While a trending market is such that the market is trending either upward or downward. The market is trending either upward or downward. So those are the two types of structures you will see in the market. If the market is not trending upward, it will trend downward as a trending market, and if it's not trending, it would be ranging or consolidating or going sideways, whichever name you want to call it. It is all part of the terms. Let's move to currency pairs. All right, we have a lot of currency pairs. We are talking about foreign exchange, right? So we have a lot of currency pairs, ranging from euro to dollar to pound to franc, Swiss franc, New Zealand dollar, AUD dollar, Canadian dollar, Japanese yen, Chinese yuan, a whole lot other. Now, these currencies, these are currencies. Euro is a currency, US dollar is a currency, British pound is a currency. These are currencies. But then we don't just trade currency, we trade currency pairs. What do I mean? You can't just buy euro and exchange it for euro and expect a change. No, there will not be a change. Euro versus euro. No, you have to be buying a currency and selling it for another currency. Okay, or selling another currency to buy another currency. So you can have euro USD, USD JPY, GBP USD, USD CHF, USD CAD, AUD USD, NSD USD. You can have all other different currency pairs like that. You buy one currency pair in it, just like the analogy I made earlier on. You're going from one country to another, so you can have your local currency in exchange for another country's currency. Okay, so we can have euro in exchange for USD. That is, you are exchanging a particular currency for another currency. When you are buying a currency you are selling the other currency. Okay, so we don't just have a single pair like euro. Okay, what am I trading? I'm trading euro. It doesn't make sense. All right, so now in currency pair we have something we call base and quote currency. Base and quote currency. Now the base currency is actually the stronger one. All right, it's the stronger one. So we don't have a weaker we have the base currency, okay, as a stronger one. Now we have the GBP USD in this instance. We have the GBP as the base currency, and we have the USD as the quote currency. So we have the GBP as the dominant, all right, and the USD as the quote currency pair. So when you see something like GBP USD, you know which one is the base currency and you know which one is the quote currency. And the number in front of it, 1.2122, whatever, the number in front of it is the price. That is, you need 1.21228 of USD to buy 1 British pound. Okay, so if this were to be 2, if this were to be 2 now, if this were to be just 2.00 whatever, that means you need $2 to buy just 1 British pound. All right, I hope you understand that. Okay, let me come again. If you need $1.2, all right, to buy just 1 British pound. All right, now we're moving on to major currencies and exotic currencies. We'll see other currency pairs now. So we have major currencies, we have exotic currencies. Now, major currencies are currencies of developed nation. All right, they are currencies of developed nations. While exotic currency pairs, they are currencies of developed nation. Currencies of developed nation / currencies of developing nations. Okay, So we have major currencies, Euro, USD, both the United States and the Euro spending nations, they are developed. British Pound, USD, the United States and the United Kingdom, they are all developed countries. So we have these developed countries and their currencies pair together with each other, and then we have exotic currency pairs as currencies of developed nation like US paired with a developing nation. All right, so that is all about the major and the exotic pairs. Now let's get into further terminologies such as pips, bid and ask price, spread, lot size, and leverage. Okay. First of all, what is pip? The pip is the sell of the foreign exchange market. The pip is the sell. That is, it is how we measure. It is how we measure price, and it is called the percentage in point. All right, now look at GBP USD, for example, and then you have GBP USD, and you have this price 1.3536. Now, when this last digit of any currency pair, all right, is called the pipette. It's called the pipette, and we do not really place an emphasis on it because it is not really essential to us. What is really essential is the number after it, which is the pip. So when price moves from 1.3536 to 1.3537, we say price has moved 1 pip. All right. When it moves to 3.3538 from 36, it has moved 2 pips, and so on and so forth. Now, when this reduced to 5, reduced by 1 pip. When it reduced to 4, it has reduced by 2 pip. All right. So from this, the second to the last number forward, we are interested in those numbers to calculate our percentage in point. Now, bid price and ask price. Now, when you open your MetaTrader, you would definitely find 2 prices. You'll find one on the right and one on the left. All right. Now, the one on the right is the ask price, and the one on the left is the bid price. Okay, the one on the right is the ask price, and the one on the left is the bid price. Okay, I will explain further. The bid price is the price at which the buyer is willing to pay. All right, and the ask price is the price at which the seller is willing to sell. Now, the difference between that bid price and that ask price, the difference between this bid price and this ask price is called the spread. All right. Now, for example, this particular one, this bid price is 1.1720. All right, let's just do it with this subscript 6 and 1.1721. all right, we see a 1 pip. All right, we see a 1 pip, which in the real sense is actually 4 pipettes. All right, it's actually 4 pipettes, but then for the sake of pip sanity now, it is just 1 pip spread. All right, what is lot size? Lot size. So now let me use this as analogy to explain what the lot size is. Now, when you're going to the marketplace, you want to buy some quantity of a product. For example, you're going to get a jean trouser. You're going to get a jean trouser. You can either 1 jean trousers or 2 jean trousers or 3 jean trousers or 4 jean trousers or 5 and so on. You get a point. So the lot size is actually the quantity of that currency pair that you are transacting. We have the standard lot size, the mini lot size, the micro lot size, and the nano lot size. So the standard lot size means you're getting 100,000 units. 100,000 units of that currency pair. So 1 pip movement of that currency pair would result to $10 increase or reduction. So if you are in 1 pip profits, you'll be in $10 profits. All right, if you are buying just 1 standard lot. All right, and on your MetaTrader you see something like 1.0 as the lot size. So if you are buying the 0.1 lot, that is a mini lot, so one pip movement would equal $1 move. 0.01, you have 1,000 units, and it's called the micro lot. And then 0.001, which is the lowest, is called the nano lot, and it's 100 units of that currency pair. And then 1 pip is 0.01 cent. That is just 0.01 cent. All right, so let's move to leverage, number 5. Now, why leverage? One of the advantage of forex trading is that it is leveraged. All right, let me explain that to you. For you to trade forex in the real sense, okay, you need millions. You need millions of dollars for you to trade forex in the real sense. But you don't have that kind of money. All right, so your broker gives you what is called a leverage option. So you can either choose between 1:1 to 1:2:1, 50:1, 200:1, 400:1 into 500:1. That is, for every of your $1, it appears as a $400. Okay, all right. So it's 1:400. We have it into 1:1000. Okay. Trading orders now. Trading orders. We have 3 types of trading orders. We have the instant market execution, stop loss orders, and the limit orders. All right. Now, instant market execution is such that you want to, but at that particular moment, you want to have an instant execution of that currency, or of that currency. So you can either buy at that point or sell at that market price. All right, you can either buy or sell. You can either click on the buy button or the sell button at that instant. Then your order will be sent instantly, and your order will be opened instantly. So we have see, on your MetaTrader you find this a lot. Pardon. You find this market execution, buy limit, sell limit, buy stop, sell stop, buy stop limit, and the likes. All right. Limit orders, we have 4. All right, and we can have up to 6, I guess. The buy stop limits and the sell stop limits. But I'm going to talk about 4. Now, we have the buy stop as the kind of order you place when you are anticipating price to continue in a particular direction. All right, so you want to place an order above the price. So what you're telling your broker is that your broker should execute an order for you if price gets above that price. For example, let's say price is here, all right, and then you are anticipating that price is going to move upward, it's going to move further up. So you're saying, okay, but you're not sure at that particular moment. You're only sure once the price gets to this level. So you said, okay, you're going to place a buy stop order at this price. So when market hits this price, your order is going to be executed, and if market continues in that direction, you're going to be in profit. Buy limit order, on the other hand, it means now we are placing an order below the price. All right, don't forget, buy stop, you are placing an order above the price. Buy limit, you are placing an order below the price. All right, what you are saying in essence is that once price comes down to this level, if the price is here, once it comes down to this level, I want my order to be executed. All right, I'm buying this particular currency pair. All right, so if the trade goes in your predicted direction, all right, you're going to be in profit. Sell stop order is just the opposite of the buy stop order. You're placing an order below the price. All right, so if the price is here currently, and you're saying that you actually believe that price is going to continue moving down, so you are placing an order at that place, that level where you feel comfortable, or where your prediction, where your analysis tells you that it's going to continue if price hits that level. All right, for example, you want to buy a pair of jeans. and you want to sell a pair of jeans, okay, but then you would only be profitable according to your analysis if a pair of jeans is equal to $2. All right, and price is currently at $1. So, and then you give your friend that pair of jeans, your friend going to the market and say, once a pair of jeans is traded at $2, help me sell this. Once a pair of jeans is traded at say 50 cents, no, we are selling, right? It has to be below price. Okay, it was initially at $1. When this pair of jeans hits 50 cents, help me sell. If it does not reach 50 cents, all right, if it's not traded at 50 cents, don't sell for me. All right. So sell limit order on the other hand, you say you want to sell at, you bought at $1, right? Okay, so you want to sell at $1.20, and you said once price comes to $1.20, I want you to sell this particular product for me. So you can place either of these orders as it suit fit your analysis now. So we have the stop orders, we have the take profit, and the stop loss. Now the stop loss is such that you want to use a stop loss in case your analysis is wrong, in case you're wrong with your analysis. So you want to instruct your broker to close your trade at this particular loss. Okay, I don't want to incur more than this loss. So you're telling your broker to close your order at that particular loss. Then take profit, you're telling your broker to take your profit. That is, you either don't want it to reverse back into it, or you are okay with that level of profit. So you're telling your broker to take profit at that level. All right, so those are the two types of stop orders that we have, and you can even close the trade yourself. You can close it yourself. All right, so Forex trading section. I guess this is the last slide here. Forex trading section, we have about 5 trading sections, but officially it is 3. All right, it is 3 because we experience volatility in those 3 sections. All right, and we have the London section, the New York section, and the Asian section. Those are the 3 I'm talking about. But on the book, in the textbook, we have 5. We have the Frankfurt and the Sydney section. Okay, so one thing you should notice: what time can I trade Forex reasonably? Let me use the word reasonably in quote. There are times where the market is sleeping. We say the market is sleeping. The market is not providing much liquidity. There is not much movement in the market, and those times are the Sydney section, in Frankfurt section, and in a little into the Asian section. Okay, so once you are coming out of the Asian section, which you have as a Tokyo here, once you are coming out of the Asian section into the London section, you begin to see movement in price. So there's a bridge between the London section and the New York section, and then you have another bridge into the London section, the Asian section and the London section. Then you have another bridge into the London section and the New York section. All right, as you can see, before the close of the London section, the New York section has already opened. So this time frame in your own local time, all right, you should find that out in your own local time is the best time that you can trade, and you will see a reasonable move in price. Okay, so I'm not saying you cannot trade on any of this time frame. Of course you can. The market will be open, but then if you want to see a reasonable move in price, all right, you should trade during the London section or the New York section, or target your trade to be when the New York section opens in the London section. All right, so thank you for watching, and that is all we have on introduction to Forex trading. If there is something you think I did not cover, please drop in the comment section, and we might have a part 2 of the introduction. So thank you very much for watching. Kindly subscribe and click on the notification bell so you would be informed when I drop another video. Alright, so I promise to drop one weekly, 1 or 2 weekly. Okay, so thank you very much for watching, and I hope you've learned 1 or 2 things from this webinar. I'll see